The latest in the Iran-Israel conflict, the U.S. Secretary of State Antony Blinken has repeated calls for de-escalation in the Middle East, saying that Washington has not been involved in that attack on an Iranian airbase in Isfahan. Iran is downplaying the attack, while Israel on its part has not commented on this officially. The IAEA says that Iran's nuclear sites are safe. So now the question is this just about posturing by both Iran and Israel? And the question about the markets, how are the markets going to read this situation over the weekend? Let's get talking about the markets, the kind of implications of this Israeli strike on Iran. Manish Singh, market expert, joining us on India Tonight. Always a pleasure having you on the show, Manish. Do tell us, how much has Israel's strike on Iran stoked fears of a prolonged conflict in West Asia, and whether or not this does turn out into be a prolonged conflict or not? At the moment, does this, spook the markets?
Hi, Vikram, good evening. Well, I mean, I would say that, I don't have any better information than anyone else, but it does look very scripted. And if I may say, it looks more scripted than a WWF fight with the drone diplomacy that we are seeing. So in my opinion, I don't see this escalating. You have seen the warning of Iranian attack on Israel, which if this happened in 1960s, it would be the Pearl Harbor moment, like Iran attacking Israel directly and leading to, probably several casualties if it was old times. But we are in the modern times, and it's not quite the same yardstick by which things work. So in my opinion, we are not going to see an escalation. It is a very measured way, the way things are moving on. And you saw that from reaction in the market. A lot of people were saying oil is going to go to $100. Now, I'm not saying it will not, but at least you're not seeing signs of that from what is happening. And given that the US is the real big power, and President Biden has an election coming up, he is managing things in a very measured way. So I don't see this escalating. Our focus should still be on inflation, on Fed, and earnings and GDP growth.
So if those are our concerns at the point that we are at right now, you're sitting in London. Tell us what the view is on the commodity markets, mainly oil and gold, because this is of huge concern when you talk about inflation in our country. How do things look?
So I would say that, the gold, there are a couple of ways of looking at it, right? So if you believe that dollar debasement is going to continue, and that is in response to US debt going parabolic, as we have seen over the last 2 or 3 years, and with that, the debt service cost increasing, then you are going to see people bid up other assets like a monetary proxy, and gold and silver comes in that monetary proxy. And you have seen moves in that. Gold has almost 15% year to date, and it may go higher from the way things are. And if you really want to see, it's actually not the gold going up, it's more like dollar getting debased. So if you measure how much of gold a dollar bought, let's say in 2015, that was 35 milligram, and now it is almost 15 milligram. So if you use gold as a basis, then you see that the dollar debasement is happening, and it started a few years ago. However, if you are an investor in US asset, US equity, and you use US dollar, then this is less material to you, because all the nominal assets are going to go up. So anything which goes up with inflation, and that's where equities come in, equities are going to go higher. And if you really want to compare this, look at what happened in other places where the monetary base has been debased. And let's look at the recent example of Turkey. If you look at what happened to that country, the currency went down, the bond market performed very badly, but the equities went through the roof because there was a price in the Turkish lira. And the earnings clearly went up, because if they have any sales abroad, then that means even more Turkish lira coming to them as earning. So I'm not directly comparing America Turkey. I think that will be an unfair way to look at it. But it is just a metrics on which you have to evaluate. Your equities can go higher even if your fiscal situation gets worse, because it's a nominal asset, and that gets priced in a debased dollar, and that could take the equities higher, S&P higher.
All things considered, if you think the current crisis or the conflict that we have in West Asia is a temporary blip, that it looks more scripted than a WWF match, and if you're saying the equities are going to go up further, the question is this time to play defensive or use dips to buy some of the blue chip equities at lower prices?
Absolutely. I think that has been my case, and that's what I have been writing and putting my trades on. Because the way I see is the GDP growth is sound. And one reason why Fed is not cutting rates is because your inflation number is still in a 3 to 4% range. Even now, if you look at the Atlanta Fed model of GDP predictions for the current quarter of GDP growth, it is still saying as 2.5%. So if you're going to have 2.5% GDP growth and you're going to have inflation of 3 to 4%, when you're having a 6% nominal growth, just without any increase in efficiency or anything else that a company does. So clearly, these 4%, 5% correction are the time to invest in good quality companies and to buy them at a discount, not a large discount, but a small discount, and to benefit from that. And this is exactly what happens in the capital market. You always buy good asset, irrespective of where the market conditions are. And if you can buy them 10% cheaper, then do so. And that is the way I look at it. I also don't look at short-term trades. For me, it's always been about more medium-term. All my trades have at least 2-year duration to run.
Right.
And on that basis, I don't feel concerned about what's happening.
And the rise in crude oil prices, that's not a real threat, Manish?
Not in the short term, because unless, again, the reason oil price has been such a fear factor for everyone, that in the past, the cartels, and most famously the OPEC cartel, were able to run this. Now, with US being the major producer, or at least, record producer compared to in the past, and them having natural gas as well, if you have that as a big supplier, it's really, really hard to put that cartel back and take the dollar up to oil up to $100, and to block the Strait of Hormuz and all, which is not quite the scenario, which is easy to do or to work with. And also, let's not forget that higher inflation just does not help the US. I mean, they can't cut rates, the debt service cost goes up, the prices go up. I mean, that is going to not be very good for the US economy and very good for President Biden and his re-election chances.
So lots at stake as far as the US is concerned. The Fed has its task cut out, and so does the RBI back home as well. We are talking about the MPC minutes of the last MPC meeting, and we'll see exactly where those fears are pegged. But that's of concern. Lots of things at play, and we will keep checking in with you to get a sense of where the markets could be headed next. Manish Singh, thank you very much for joining us on India Tonight.
Thank you.
If you like this video, then like, share and subscribe to ET Now.